$11 billion lie that shook America. In the early 2000s, America was still reeling from corporate scandals that shattered investor confidence, but among them, one case stood out for its sheer scale. A telecommunications giant, billions of dollars in false profits, and one of the largest accounting frauds in U.S. history. This is the story of WorldCom and its CEO, Bernie Ebbers. In the 1980s, Bernard Ebbers was not a Wall Street executive. He was a former basketball coach and motel owner from Mississippi. Soft-spoken and deeply religious, Ebbers did not fit the image of a corporate titan. Yet through ambition and aggressive expansion, he would build one of the largest telecom companies in the world. WorldCom began as a small long-distance reseller, but during the 1990s telecom boom, it grew at astonishing speed. Through massive acquisitions, WorldCom swallowed dozens of smaller telecom companies. Its biggest deal came in 1998 when it acquired MCI Communications in a merger worth more than $30 billion. At its peak, WorldCom controlled a significant portion of the global internet backbone. It became the second largest long-distance telephone company in the United States. Investors loved the growth story. Wall Street praised Ebbers as a visionary, but behind the rapid expansion, cracks were forming. The late 1990s saw a massive technology bubble. Telecom companies laid miles of fiber optic cable across the country. Internet traffic surged. But when the dot-com bubble burst in 2000, demand slowed dramatically. Telecom companies were left with excess capacity. Prices for services began to fall. WorldCom's revenues declined, and that is when the accounting manipulation began. To maintain the illusion of steady growth, WorldCom executives engaged in a massive accounting fraud. The scheme was deceptively simple. Normally, everyday business expenses, such as line costs paid to other telecom providers, must be recorded as operating expenses. These expenses reduce profit, but WorldCom did something different. Instead of recording billions of dollars in line costs as expenses, the company classified them as capital expenditures. In accounting terms, this meant they were treated as long-term investments rather than current costs. The effect was dramatic. By moving expenses off the income statement, WorldCom artificially inflated its profits. Quarter after quarter, the company reported earnings that did not reflect reality. Between 1999 and 2002, WorldCom overstated its assets and profits by more than $11 billion. It was one of the largest accounting frauds ever uncovered. Inside the company, pressure was intense. Executives demanded that financial targets be met at any cost. Employees who questioned numbers faced resistance. But eventually, internal auditors began noticing irregularities. One key figure was Cynthia Cooper, head of internal audit, working late nights. With her small team, Cooper investigated suspicious accounting entries. What they discovered was staggering. Billions of dollars had been improperly classified. The numbers did not add up. In June 2002, WorldCom publicly admitted that it had overstated earnings by nearly $4 billion. Further investigations would raise that number to more than $11 billion. The market reacted instantly. WorldCom's stock price collapsed. Once valued at over $180 billion at its peak, the company was suddenly worth almost nothing. Investors lost billions, employees lost jobs and retirement savings. In July 2002, WorldCom filed for bankruptcy. At the time, it was the largest bankruptcy in United States history. Federal prosecutors moved quickly. Investigations revealed that senior executives were aware of the manipulation. Bernie Ebbers maintained that he was unaware of the accounting fraud, but prosecutors argued that as CEO, he had pressured executives to meet earnings targets and benefited from inflated stock prices. In 2005, Ebbers was convicted of securities fraud, conspiracy, and filing false documents with regulators. He was sentenced to 25 years in federal prison. It was one of the harshest sentences ever given to a corporate executive. The WorldCom scandal had far-reaching consequences. It came just months after the Enron collapse, further eroding public trust in corporate America. Together, these scandals exposed serious weaknesses in accounting oversight and corporate governance. In response, the U.S. government passed the Sarbanes-Oxley Act in 2002. This law imposed stricter financial reporting requirements, increased executive accountability, and strengthened penalties for corporate fraud. Executives were now required to personally certify the accuracy of financial statements. Internal controls became mandatory. The era of unchecked corporate accounting had ended, at least in theory. For employees and investors, however, the damage was permanent. Thousands lost their jobs. Retirement accounts tied to company stock evaporated. Communities dependent on WorldCom offices suffered economic fallout. The company eventually emerged from bankruptcy under a new name, MCI, and was later acquired by Verizon. But the original, WorldCom, was gone. Its collapse became a case study in corporate fraud. The story of WorldCom is not just about accounting rules. It is about pressure, about the dangerous expectation that growth must never slow, about executives chasing stock prices instead of sustainability. Accounting fraud does not begin with spreadsheets. It begins with denial, when companies refuse to accept declining profits, when leaders prioritize image over truth, when numbers are adjusted to protect reputation. Fraud becomes possible. Bernie Ebbers spent years in prison before being released due to health issues in 2019. He died the following year. His legacy remains deeply controversial. To some, he was a small-town entrepreneur, overwhelmed by corporate complexity. To others, he was the architect of one of the largest financial deceptions in history. But the numbers tell their own story. $11 billion, an empire built on inflated assets. A telecommunications giant brought down by accounting entries. Today, financial regulations are stronger, audits are stricter, oversight is tighter, yet corporate fraud still appears in new forms. The WorldCom scandal serves as a warning because when transparency fades, when accountability weakens, when profits are manipulated to maintain appearances, the consequences can be catastrophic. WorldCom was once a symbol of American business ambition. In the end, it became a symbol of corporate excess and accounting fraud, a reminder that even giants can fall, and that sometimes the most dangerous lies are written not in words, but in numbers.